All right, how about now? Good sound? Thanks, bot. I think we're good. Okay. So, welcome to Charts and Coffee. Lots of coffee, lots of questions. All right, I think we're good. Yeah, I had my mic muted. Been there, done that before. All right, great to see everyone. Thank you, as always, again, for making time out in your day, in your schedule to join our show. And a couple basic ideas for the morning. We are exhausting, at least we're trying to. And let me grab my drawing tool here. I'm going to show you something. There's a couple different ways you can draw support and resistance, right? Just two. You can either project levels. Trend lines would be a projection. Fibonacci is a projection. Where might the market turn around if it gets there? The other kind of support and resistance is, what did the market do last time it got here? I know, subtle, but huge in terms of the kind of levels that question will plot. I like the latter. What did we do the last time we got here? And what kind of market environment are we in? Now, that second part of the question is probably just as important as the first, right? So question number one, what did we do last time we got here? Question number two is, what's the difference in the underlying market environment? Let's do the same thing on the S&P. Squeeze in the year. I'm not going to just kind of pick out the well-chosen example, right? What was the last time that we got here? Where are we stalling now? In fact, the last time that we got here, all these purple lines right here, purple, I could have drawn a few more, but these are the ones that are in play where current price is at. These are automatically drawn Darvis. Darvis asks the question, what did we do last time we got here? In other words, we're using previous support and resistance to plot these levels and go forward. So remember, is there a secret to drawing trend lines? No, there really isn't a secret, right? The secret, if you will, that most traders will keep close to the vest is, hey, which one do I use? And then how do I go about doing it? For me, Nicholas Darvis, late 1950s, fast forward, modernizing Darvis, Darvis 2.0, available at countdowntrader.com. That's going to answer this question about the zone. And then the second part of the question is, are we overbought? And then I'm going to bring you to, the world's greatest oscillator is a free slow stochastic, gang. A free slow stochastic. But here's the secret sauce. 21K, 3D, 80 upper level, 20 level on the bottom, high, low. Listen to me now, believe me later. It just works. Give it a try, right? Don't take my word for it. I love it, but give it a try. There's your combination right there. Same thing on the ES. We'll head on over to the YM. This one's a little bit higher. Just a smidge. But the closer we get to this zone, I would expect we're going to start to exhaust. Actually, there's that 200 exponential moving average. Not as clear in terms of that crispness of moving, projecting that, seeing where we stalled before, going forward and just pushing that forward, saying, okay, we're likely to do something similar there again, as long as we don't have a substantially different underlying market trend, like an uptrend, right? Where I'm not really looking then at resistance at all, looking at support. And there you have it. Those are the three major averages. That's the biggest thing this morning. All right, first question, as always, the show is about your questions. And the first one we've got here is Zach. All right, Zach's question is, with so many names, Michael Burry, Bill Gates, and big hedge funds saying a crash is coming, yet investors are so bullish. How can we ignore these smart financial leaders? So that's, first of all, there's a lot of assumptions there. The first assumption is, and Zach, I mean this sincerely, ask yourself, really, these are three of probably the most legendary capitalists ever. Do you think they run charities when it comes to financial advice? Do you think they're in the business of public service announcements? I'm not going to answer that question for you, but if anyone's been listening to Charts and Coffee for any length of time, you know what I think. So that's the first question to ask. I don't want to poison the well. I really want you to ask yourself sincerely, are they really out to help the little guy? Are they really out to help the retail investor? Or could they possibly be talking their book? Okay. Second is investors are bullish. I don't know if investors are so bullish. I really don't know. I think that we saw a strong July. I think that a lot of investors are still sitting on the sidelines in cash. So I don't know that investors are so bullish. I don't have a way to really view what that means, right? In other words, are we seeing a lot of money flowing into markets? So you might say, Rog, how would I measure that? I would look at inflows, right? You can study, is money coming into the market, and is it more money than we've seen before? So we'd want to look at a rate of change of whether truly dollars are coming into the market or not, right? Okay. So that's the first part. How can we ignore them? This is the easiest question to answer. If I were playing golf and a really good hockey player, I mean, we both hold sticks in our hands and play, right? Or a really good lacrosse player came to me and said, this is the club and this is the shot. Remember, I'm playing golf. They're playing hockey or lacrosse. Do I care what they have to say? I really don't. I really don't. Because we're playing different games, right? Retail traders and investors are playing a different game than any one of those three groups, right? So how can we ignore them? Easy. We're playing different games, right? I think the other part that makes it really easy to ignore them is, do you think, kind of going back to the first question, do you think they're already in the market or are they building a position? Now, let's not be, I think that we don't want to be naive about why anybody speaks out publicly. Most traders, including, like, for example, I'll tell you all, if I've got a position on, that's talking my book. We all have to be aware of, am I bullish because I'm long, or am I long because I'm bullish? Sometimes we will talk bullishly about a market, heck, because we're already in, long or short, right? So bullishly in this case, long. So that's the way I answer that. I ignore them all the time, and I've done pretty well for 32 years because we're playing different games. I don't know where they're positioned, and I don't know their stops. So really, what's the advice there? What have they really told us? Nothing, right? So I hope that makes sense, and I hope you can, see, all right, how do I measure if money's really coming into the market? Do I have any idea of whether or not they're already built into the market, and what's their cost basis? What's their time frame? What's their time horizon, right? And what's their stop loss? Unless you know those three things, we really actually don't know anything. So I hope that makes sense. Next up, Sam K, SPY, and GLD. Sure. So we're going to go to ES and GC, right? We're going to look at the futures market view of an incomplete view of those two markets, because remember, SPY GLD 9:30 to 4, futures almost 24 hours. So SPY, again, kind of going back to what we talked about earlier on the daily, Sam, we're at an exhaustive level. And GLD via the GC futures, let's take a look there. What do we have? Still trying to climb up, Are we overbought quite yet? Well, here's what I will tell you happened to me, and in all transparency, I was looking for a trend to continue here, looking for resistance in the wave and a downtrend. We're in a pretty sensitive macroeconomic environment where, of course, real yield, which is the nominal yield of a bond minus the rate of inflation, is sending, at this point, gold a little bit higher. I'm not bullish in gold, but I will have to see whether or not this level of resistance, carry that forward, right, is the next area of resistance or not. The closer, though, because now we're talking a choppy market. It's freshly choppy. It's choppy. So if a freshly choppy market can get up to this 80, right, this high level, gang, World's best oscillator. And it's free. Slow stochastic. It's on any platform, 21K 3D, until that thing gets to about 80, or at least closes in at 80 with a price level corresponding with it. That trend follow was stopped out. Now it's whether or not we actually are overbought and can focus on the short side. I'm not going to flip to being bullish. That's a momentum trading mindset, which is fine. It's just not the mindset that I use. I'll follow that the downtrend is broken. We now have chop. In chop, overbought, oversold. So I hope that makes sense. Thank you for the question. All right, Furman asks, can I speak to my approach during the first 30 minutes on a slight gap down day? Well, let's take the S&P. And again, make sure we assess gaps individually. This is a vanilla gap, right? So far, although we still have 19 minutes, so far we're not opening below the low of yesterday, Monday's session. That would be a true gap. I didn't name these things. Vanilla gap, yeah, I just call it a vanilla gap. It's a plain Jane pedestrian gap, right? So a plain old pedestrian gap usually doesn't have quite the same fading, meaning buyers coming in to buy a gap down, the same fading as say you'd see in a true gap where we open below the low. So I'll just treat this as a vanilla gap and go through my typical process of focusing on ranges during the clearing range. And then if I want to fade the gap, I'll focus on a shorter term high-low range after the bell and see if the momentum reveals itself. Remember, if you're playing a gap, right, specific to the gap technical reality, right? A gap is a technical state of the market. Because remember, a gap doesn't exist. The gap is imposed on a market that opens and closes. Notice there's no gap on the S&P futures. It's been open during all that time. The gap phenomena is something that's going to apply to the SPY, right? So keep that in mind. That gap is being viewed by a very specific group of market participants. It's equity traders. It's equity options traders. So after 9:30, we'll measure the reaction, and that's what I'll do. In my opinion, the euro, US, and dollar and all commodities will be exciting to trade as we approach the next. I'm sure it will be. It never fails to be a time where a lot of emotion is expressed. Sure, a lot of emotion, a lot of opinion. Sure. Next up, double green on bonds, but no propulsion dots. Bonds are, let's see here. Bonds are trying to go. Let's see if we can make sure we can see this chart all together. There we go. Karthik, yeah, bonds are green. Well, when you say double green, I don't have double green on ZB, and I don't have double green on ZN. Let's double check. These things can change quickly on the daily. All it takes is that 8, 13, 21, and 34 to align properly. I don't have double green, Karthik. So I have green grab candles. But I do not have double green. So my insight is we're still dealing with chop. That's my insight until we go double green. And by the way, a lot of traders ask, okay, Rag, why aren't NASDAQ bonds? Why aren't these double green? You know, this tool that you use. So let's lift the hood and look under and take a look at the motor of our multi-trend of our trade flags. It is the 8, 13, 21, and 34 EMAs. These are not magical EMAs. They just tend to work really consistently. The next thing that I want to remember is until they are structured from the smallest period to the largest moving higher, or the smallest to the largest moving lower, that is going to keep the lower row of the multi and the second trade flag neutral, because those moving averages have not yet aligned in that way. Or the common jargon is stacked. They're not stacked with the proper order. So until they're 8, 13, 21, 34, quote unquote, stacked, and that's what the lower row of the multi-trend is measuring. So one of the things that I do with stacked moving averages that is fairly unique is I'm not interested in looking at it across multiple time frames. I don't use multiple time frame analysis. If it worked, then nobody would have any issues finding trades, because we're all taught multiple time frame analysis. in large part, that's not, let me put it this way. When we're looking at a commonality across all sorts of successful traders, what I found is there's 20 or 30 things that successful traders are going to do. But what I start looking at is where are the overlaps? And the overlaps are seldom, if frankly, never indicators. They're usually varied. And it's never, well, I turned successful when I started multi-trade time frame analysis. That's never a common trait. It's understanding what are the common traits? Directional bias. In other words, most traders that I have found that are successful, the ones, again, this is my, 30 years, but 30 years of asking traders, what do you do? Writing it down and then comparing to all the other, at this point, it's hundreds of traders that I have watched personally are profitable traders. The first thing is they usually have a directional bias. They know which way they have a preference for the market to move. They also have a zone. They're not just market ordering because the markets are moving a certain way. They have a particular price that they're looking at. The third, a little bit more nuanced, is risk management and position size. They all made risk management and position size basically job number one. And then everything else kind of varied from trader to trader. I mentioned that really emphatically because a lot of traders are really interested in, well, Rag, does the trend on the hour have to agree with the trend on the daily, and the trend on the 15 have to agree with the trend on the hour? No, that has never been a commonality that I have observed amongst. It's one of the variances that some use and some don't. But unless multiple traders say, I turned the corner, doesn't matter. That being said, 8, 13, 21, 34, when those are structured bullishly on this time frame, then we have a double green. If not, I can go look for another time frame that might have that structure. But remember, the time frame dictates the time horizon, right? A 1 hour chart doesn't guarantee the daily is going to move. A 1 hour chart tells me that with about with a time horizon that reflects 1 hour price behavior, that is bullish. So the fallacy of a 1 hour chart influencing a daily chart, which have two different time horizons, is one that I don't want to go down. So that means I wait for the daily, right? I know other time frames are bullish, but this one isn't. I hope that makes sense, gang, because I still see a lot of traders traveling down the multiple time frame horizon analysis rabbit hole, and it just is not one that is one of those overlapping difference makers for successful traders. Some use it, some don't. I'm of the latter camp. So I hope that makes sense. And so no pullback buys, Karthik. No pullback buys there, my friend. All right. Let's see. Good morning, Off-Road Bear. Dollar. What's up with the dollar? And smash that like button. I do appreciate that. I do appreciate it. And again, if it's a needle mover for you, again, if these discussions are ones that, again, are getting you to look at the market in a different way, not the way everyone else is looking at them, because frankly, if that worked, we'd all be successful traders too. So, sometimes you're looking at the market in a distinctly different way than other traders. And the reason is actually a little harsh. Most traders lose. Why would I want to do anything like the masses, right? Why would I want to listen to what the masses are listening to? In other words, shut television off. You think there's a soul on television that holds the secrets to your successful trading? You do. Not even me. You do. Right? Risk management, position sizing, directional bias, right? Picking a side and waiting for your price. Those are three of the most common things that I've seen across hundreds of traders who do well. It wasn't listening to television, that's for sure. So dollar. So this goes back to Off-Road Bear, something that we talked about a couple weeks back. The best days for the dollar are behind it. Now, I've heard some folks out there who clearly have no understanding of macroeconomic central bank analysis run around saying, well, the dollar is getting ready to fly higher because what, a secret squiggle said so? Now, think about it this way. Rate of change. European Central Bank is embarking on their rate hiking. That means the euro is going to be strong. That means when I look at the 6E, which is an inverse or negative correlation to the dollar, it's not in the same quality downtrend that it was before. It's likely going to keep moving higher. And yes, the dollar is likely going to keep moving sorry, the euro is going to keep moving lower and the dollar is very likely going to keep moving higher, as long as, remember, the dollar is never just the dollar. Another fallacy, a lot of traders talking about the dollar. It's the US dollar versus euro, pound, or euro, yen, and pound, and in that order. If my 6B is actually starting to pressure and break the downtrend, if my 6J is not in the same downtrend that it once was, yes, the US dollar is losing some of its swagger. So remember, as we wind down our tightening cycle, which in the US we are, we're well into a mature, nearly complete. By November, December, stick a fork in it, it's done. But other central banks are still hawkish or newly hawkish. And you look at the currencies that make up the contrast that is the dollar, right? Because it's never just the dollar, it's a basket. Yeah. The best days are over. However, the path of least resistance, clearly, I agree with you, is probably still up. And I would still have a bullish swing. But remember, we're going to see a lot more volatility, and we're not going to see that parabolic move likely going forward. All right. Okay, gang. And just like that, that is the end of our show. Thank you as always. I know a lot of you get those questions in early, which is awesome. I hope that the free tools over at Countdown Trader are moving the needle for you. And that if you're looking to get the most out of those tools, by the way, use them, share them with friends, say, hey, I've got this tool that's working. It's absolutely free. They don't even ask you for your email address. Go grab those tools, put them on your chart, and you're going to see they're very plug and play. The levels are there. The colors are there. If you can read a traffic light, you can use the tools. If you want to see how I use them, come join me over in the Sector Secrets Mastery, and we can see how we can continue to elevate where you're heading with your trading. All right, gang? Learning to make your own decisions and not caring what hedge funds or Michael Burry have to say. Not that they're not doing well, but they're playing a different game. All right, gang, be good to each other. I'll talk with you soon.